You can beat 99% of investors, build significant wealth, and truly secure your financial future. This isn't complex day trading. It's a revolutionary yet simple 3 ETF portfolio designed for anyone tired of underperforming. But one critical, counterintuitive step almost everyone misses transforms this simple strategy into a wealth-generating powerhouse. If you're new here, I'm Detective, and we're all about cutting through the noise to bring you actionable, data-driven investment strategies. If you want to unlock financial freedom and grow your wealth with intelligent ETF choices, make sure to hit that subscribe button and turn on notifications so you never miss another market-beating strategy. Most investors dramatically underperform simple benchmarks. Why? Over-complication, chasing trends, and emotional decision-making. The average retail investor, according to Dalbar's quantitative analysis of investor behavior, consistently achieves returns significantly lower than broad market indices like the S&P 500. While the S&P 500 averaged 9.8% annually over the last 2 decades, the average equity fund investor only saw about 4.5%. That's a 5.3% gap annually, compounded over decades, which translates to hundreds of thousands, even millions in lost wealth. People pay high fees for active management that rarely beats the market after costs. This is the problem we solve. The secret to outperformance isn't complexity, it's elegant simplicity combined with disciplined execution. We're leveraging the proven power of broad market exposure through exchange-traded funds, or ETFs. These are baskets of stocks or bonds that trade like individual stocks, offering instant diversification and incredibly low costs. Our strategy condenses the vast investment universe into just 3 powerful, highly efficient engines. First pillar, the primary growth engine, is a total U.S. stock market ETF. We recommend funds like VTI, the Vanguard Total Stock Market ETF, or ITOT, the iShares Core S&P Total U.S. Stock Market ETF. These ETFs provide exposure to over 3,500 U.S. companies across all market capitalizations, from mega caps to small caps. Why this broad approach? It ensures you're capturing the entirety of American economic growth without trying to pick individual winners. VTI, for instance, boasts an ultra-low expense ratio of just 0.03% and has delivered an average annual return of approximately 12.7% over the last decade, handily beating most active funds. The second pillar provides essential global diversification, a total international stock market ETF. Consider VXUS, the Vanguard Total International Stock ETF, or IXUS, the iShares Core MSCI Total International Stock ETF. Why is this critical? The U.S. market doesn't always lead. Economic growth cycles shift globally. VXUS invests in over 7,700 companies across developed and emerging markets outside the U.S. This broad exposure reduces single-country risk and captures growth from burgeoning economies worldwide. Its expense ratio is still a minuscule 0.07%. Over the past decade, while sometimes lagging the U.S., it has provided crucial diversification, maintaining average annual returns of around 5.9%, smoothing overall portfolio volatility. Third and final pillar is the stability anchor, a total U.S. bond market ETF. Look at BND, the Vanguard Total Bond Market ETF, or AGG, the iShares Core U.S. Aggregate Bond ETF. While bonds might not offer the explosive growth of stocks, they are absolutely vital for a robust portfolio. They provide stability during stock market downturns, consistent income, and crucial rebalancing opportunities. When stocks plunge, bonds often hold their value or even rise, providing capital you can reallocate to buy beaten-down stocks at a discount. BND, for example, holds over 10,000 diverse bonds with an expense ratio of 0.03%, providing a reliable foundation.
Now, for the new edge, the secret weapon that makes this simple portfolio beat 99% of investors: dynamic, threshold-based rebalancing. It's not just what you hold, but how you manage it. Most people know they should rebalance, but they either do it too frequently, too rarely, or based on emotion. Our strategy is precise. You set a target allocation, for instance, 70% VTI, 20% VXUS, 10% BND. Then you only rebalance when any asset class deviates by more than 5% from its target. For example, if your VTI allocation grows from 70% to 76% or shrinks to 64%. This systematic approach forces you to sell high and buy low, not based on market sentiment, but on predefined, unemotional parameters. This disciplined action captures alpha that active managers often miss and passive investors leave on the table. This is the difference between simply holding and actively optimizing without active management fees. Let's talk allocation. A common starting point for a moderate investor is 70% VTI, 20% VXUS, 10% BND. A younger, more aggressive investor might opt for 85% VTI, 10% VXUS, 5% BND. An older, more conservative investor might go 50% VTI, 15% VXUS, 35% BND. Adjust based on your personal risk tolerance and time horizon. Now, the proof of its power. Historical simulations across multiple market cycles consistently show that a low-cost, globally diversified portfolio managed with disciplined, dynamic rebalancing outperforms 99% of actively managed funds and individual investors over the long term. Why? Because you minimize costs, capture broad market returns, avoid behavioral pitfalls, and systematically capitalize on market fluctuations. The combined expense ratio of this portfolio is under 0.05% in many cases. That 1 to 2% difference in fees compared to active funds, compounded over 30 years, can mean having an extra $500,000 in your pocket. This isn't just theory, it's mathematical reality. Building this portfolio is surprisingly simple. First, choose a reputable low-cost brokerage like Fidelity, Vanguard, or Schwab. Second, determine your target allocation based on your risk tolerance. Third, buy the ETFs. Many brokerages offer commission-free trading for ETFs. Fourth, set a reminder for your threshold-based rebalancing check. This typically means glancing at your portfolio value percentages a few times a year. This entire process takes mere minutes annually. Forget constant market watching, endless news cycles, or complex analysis. This is smart investing, simplified and optimized for superior returns. For generations, people placed their trust and their money primarily in a traditional bank. They sought security, a safe place for their savings. For many, the imposing structure of a bank with its visible bank signage, secure main entrance doors, ever-present ATM and security cameras symbolized ultimate financial safety. Professional branding conveyed stability, and the concrete pavement beneath felt solid. However, a traditional bank savings account today offers minuscule returns, often less than inflation, effectively eroding your purchasing power over time. While the security of a bank for short-term cash is undeniable, this 3 ETF portfolio provides a path to significant wealth growth with diversified, market-driven security that far surpasses what any conventional bank account can deliver. We're talking about moving beyond just safeguarding your principal to actively growing it with confidence. This powerful yet simple 3 ETF portfolio is your blueprint for financial independence. If you found this breakdown valuable, smash that like button, share this video with someone who needs to hear this, and if you're not already, subscribe to Dividend Detectives and hit the notification bell. We're here to empower your wealth journey. See you in the next one.